Hey, it's James Nicholson and welcome to this YouTube channel where we're taking you on a journey of our buy-to-let property portfolio growth. Now this year I'm expanding my personal portfolio, but I'm taking you on a journey as well where I build a portfolio for my two daughters, Georgia, who's 21. We've just purchased our first property together up in Doncaster. You can check out the channel to see how that all worked out. And we're going to be buying some properties for my daughter, Emily, who is just 1 year old. So we're going to teach you how we structure that, how we find the deals and everything in between. So how you're going to join us on this journey is take that finger of power, smash that subscribe button over there. Do it now and then hit the bell notification till it turns blue. And then you'll see all the content that we bring out. Now, in this video, I want to talk about buy-to-let mortgages and how do you use a buy-to-let mortgage to get an investment property. Well, buy-to-lets and residential mortgages are very, very different. And in fact, a buy-to-let mortgage is more easy to get than a residential mortgage. So if you wanted to buy a £400,000 house, then you would need to get a 10% deposit on a residential mortgage, which is £40,000. And then they would loan you the £360,000 that you earn. You would need to earn a quarter of that, right? So they'll give you 4 times your salary. So if you are on 100 grand a year, you can borrow 400 grand. Now, the average salary in the UK is nowhere near that. So that makes that very, very difficult. But you might come into money because maybe you release some equity from a property you already own, or you get some inheritance, or you're really good at saving over a number of years. And so buy-to-let, all they actually are really focused on as the lender is, does the numbers stack up? So if you wanted to buy a £100,000 property on a buy-to-let mortgage, which there are tons of places you can get those, you would need to save up £25,000, £25,000 being a quarter of that. And so a buy-to-let mortgage, they will lend you 75% of the value of your property that you're looking to purchase. So I've just bought a 60 grand property and I would be able to get, I'm trying to think of what a quarter is here, 45, yeah, is that right? 45,000. I could get a mortgage, I need to get a 15 grand deposit, right? And so that's what you need to think of here is the 25%. Now, they are going to look at things like, do you have good credit and stuff like that? Of course they are, but it's not as important as it is on your residential mortgage. Now, the reason it's not so important is because you're not going to be the one paying it back. Your tenant is, right? So the tenant's going to pay you rent. You're going to make the difference between the rent and the mortgage payment as your profit for doing that. So they're not so reliant on you being a good payer, which is why they're more likely to lend. Now, they're also more protected as a lender because you've had to give 25% of the value of the property as a deposit, right? So that's a good thing. Now, with a buy-to-let mortgage, you will have 2 options to repay that. You can pay it back by interest only, or you can do a repayment mortgage. Now, normally on a residential mortgage where you live, you will probably be more likely to do a repayment mortgage, meaning every month you pay the bank, the mortgage payment. Some of that would go towards the interest that you owe, and some of it would be paying down the balance. Now, on a buy-to-let mortgage, you're way more likely to just pay the interest. And the reason for that is because you want to keep the payments low for cash flow. So say you borrowed 100 grand and you had a 2% interest. That means you'd be paying 2% was your rate. You would be paying £2,000 back every single year. So £2,000 split over 12 payments, what is that? Like £180, something like that? Whereas if you paid repayment, you might pay 5k back a year. And so you might pay like 450 back every single month. So what we're trying to do here is reduce our payments. Now, if you pay interest only, which is the most common thing that you would do on a buy-to-let mortgage, then at the end of the term, so if it was a 25-year mortgage, you would still owe this 100 grand up here, which worries people. A lot of people get worried about that. They like to pay things off. Now, here's the thing. You can just get a new mortgage for another 25 years. So that could just keep going and you just keep paying the interest. And so if you think about it, in 25 years from now, 100 grand is going to be considerably less valuable as it is today because of something called inflation. And so if I asked you guys to find 100 grand now to pay off your mortgage, you would struggle to get 100 grand. But if I asked you to get 20, which in real world terms is what it might be worth, similar to what 20 grand is today, you could do that, right? Or in 25 years, you could just get another mortgage, a new mortgage, pay the 100 grand off, but now get a new mortgage with a new lender for 100 grand, and you could switch it to repayment, right? And then you'd be paying it off each month. But at that point, in 25 years, rather than getting 500 rent today, you might be getting like 1,500, right? So you're going to be able to keep more money in your pocket. Hopefully that makes sense, right? So a buy-to-let mortgage is more of an investment tool. It's a total investment tool. The goal of it is to keep your payments down and so you can make a margin. Now, they're going to be looking at other factors in this as well. So a consideration is how much rent do you achieve? Because they want to make sure that you make some money. In fact, it's good because the bank, the mortgage lender, will only lend you money if you're going to make profit, right? So if you're going to be paying them £500 and you can only get £500 rent, they're not going to lend you the money, because if you don't make profit, you're going to get disinterested. And if anything went wrong, you're not going to have any money to fix a boiler or a roof or anything like that that might go wrong. And so they don't want to lend people money on that basis. And what that means is in the southeast of the UK, it might mean that you can't actually borrow 75% loan to value because rents relatively are low in the southeast compared to the value of the house. Now, don't get me wrong. I'm not saying rents are low, but what I'm saying is you might have a flat that's worth, for example, I've got a flat in Dorking. It's worth 250 grand and I get £1,000 a month rent, right? Whereas up north, I've just bought a house for 60 grand and I'll get £500 rent. So in the north, I could buy two 60 grand houses for 120 grand. So I'm in the deal for 120 grand and get my £1,000 rent. Whereas in the south, I've got to invest £250,000, nearly double, to get my rent of £1,000. Now, that looks like you should just invest in the north. Now, there's two reasons why you might want to look at different areas. So I invest in the south because I want to get rental income, but I will get more capital appreciation. House prices in the south of England go up faster than they do in the north. So I also invest in the north for cash flow. So the return on my investment is better in the north, but the house prices don't go up so fast. So I mix it up and I have a portfolio in Hastings in the southeast, that's on the coast, in Dorking in Surrey, and in Doncaster up north as well. So I mix it up and have different properties in different areas. So I hope that makes sense. But that's what I want you to start thinking about with a buy-to-let. What they'll do is they will look at your salary, they will look at stuff like that, but it's not the deciding factor. More the deciding factor is, does the deal stack up? If you want to buy a 100 grand house, they'll lend you up to £75,000, which is 75%. The interest should be interest only. That will keep your payments low so you can make profit each month. How you'll pay it off, you will pay it off with inflation. So in 25 years, you'll still owe them 100 grand, or 75 grand if that's what you borrowed. And then you will then flip it and put it onto a repayment mortgage, which will be way more achievable and affordable back in that time, because 75 grand in that time will be very, very small compared to what it is today. So any questions you've got on buy-to-let mortgages, do comment below and do subscribe to the channel, as I said earlier, and give that little like button a quick tap. Go on, smash that like button over there. And that helps me with YouTube, guys, to get more views on this. But do subscribe and do join us on this journey. Monday morning, I'm going back up to Doncaster. Let's see what the property's looking like. I'll make you an update video on that, and so you can see how we're progressing and moving forward. I'm James Nicholson. Stay blessed, and I'll see you guys very, very soon. Bye for now.